You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that funky tune. I love it. It just sticks in my brain throughout the whole show. It makes me want to dance in my little studio here. Welcome to This Week in Futures Options, like the name implies. This is the program on the old Options Insider Radio Network, where we break down all of the interesting and unusual options activity that's going on the other side of the fence, the futures options side of the fence. So not your apples and your Facebooks, but your crude oils, your corn, your gold, your T-bills, your whatever, lean hogs maybe. You never know where we're going to find the week that's going to light it up. That's what makes the show so fun. It's kind of a cornucopia. Whatever's hot that week's going to be on this program. We're going to break it down for you in a lot of great detail. We'll put together some reports after the fact. If you guys are following along live and you want to check out the action for yourself, then check out the link that we tweeted out earlier for the actual TWIO report. You can also find it over there on cmegroup.com/TWIO. This week, it should be futures options. They have This Week in Options, so we'll do what we can to remedy that for them over there. But check it out over there for yourself, and you can see a live, updated version of the report that has all the detail that Nick and I are going to break down on the show today. And speaking of Nick, I am joined by my cohort, my partner in crime, the yin to my proverbial yang, Mr. Nick Howard, the founder and CEO of Bantix Technologies and the creator of a little platform we like to use around here called QuickStrike. Nick, welcome back to This Week in Futures Options, sir.
Hey, Mark. Good to be back, ready to go for the week.
And you are beaming in remotely. It shows your commitment to the show, sir. You just got through giving a nice lecture over there at the Entrepreneurial Center at Northwestern, but never one to shy from a show. You hopped right on TWIFO there from, I believe, the library there. So that shows your commitment to the program, sir.
Yeah, I'm sitting in a conference room at the Farley Entrepreneur Center, and just had talked to some students with one of our other Options Insider friends, John Nelson. One of the professors here is a friend of mine, Mike Marasco from high school, and had us come in and talk to them about small companies in the business space and working with big companies, that type of stuff. So, but we're ready to go here I will explain. We did this week in options for the CME because they already know their futures options. We could still call ourselves TWIFO or we could still call ourselves TWIFO. People just have to go to the TWIO report. So
it's like in Brazil, they just call them nuts, not Brazil nuts, right?
Yeah,
so there you go.
Right, exactly. Or filberts, right? Whatever it is, or Brazil nuts. So I think we still go with the TWIFO, but you got to go over to CME and get the TWIO. It's the same thing. Everybody will know after today.
There you go. CME always likes to inject their little bit of branding on everything, but it makes sense. It's all futures options to them, so why differentiate them? But let's kick things off as we are wont to do, and certainly have for the first few episodes, I should say, really, of this program, Nick, is start where the action has been fiercest, where a lot of our listeners are inclined to want to play and are indeed interested. That is indeed out there in the realm of crude oil, aka WTI. That's the product we're looking at. There's others out there, of course, Brent and others, but we look at WTI primarily here on the old TWIFO program. I'm going to start saying TWIO now, so I have to correct myself mentally, Nick. But yeah, it's an interesting week, as you guys probably know from watching the news. Some raging wildfires out there in the Calgary, Alberta oil sands region, and that, of course, has caused some issues structurally for all the different producers out there, to say the least. And we saw that cause a pretty interesting and aggressive spike in the middle of the week here from a crude perspective. And so it's been an interesting week to watch kind of what crude has been happening out in crude. Maybe we'll start in an interesting part of the crude discussion, because we were having a little bit of a back and forth debate on our volatility views program, Nick. And I thought this would be a good program to settle that. We were kind of discussing what was actually more active out there from a volatility perspective in crude. Was it the puts or the calls? And I was saying, this past week, not surprisingly, there was the calls, particularly on the nearer term portion of the curve, really got a lot of life. Not surprisingly, you get a nice, decent gap up in the underlying. People, particularly in the front month, second month out or so, are going to gap into calls en masse, causing a bit of some life up there to that call wing. And then that seems to be what we saw unfolding this week as well. Some people were arguing, well, puts longer term have the heftier bid. And sure, if you go out to the end of DEES or back beyond, puts still are leading the charge overall from a straight up implied volatility premium, implying there still is some structural concerns out there for crude over the long term. But in the near term, certainly over the past week, and this is This Week in Futures Options, calls were where the action was at. Would you concur, sir?
Well, yeah, I think from a volatility standpoint, what you're going to see is, the skew, it got less negative, right? And how that happened was, again, looking at the report you've been talking so much about, the quick skew report, it lets me right away take a look and see how the puts and calls are moving in relationship to each other, not just the risk reversal as an absolute number, but the calls definitely took on a bid this week. So for much of the last few weeks, that volatility has been below the at-the-money volatility level. But this week, we're starting to approach a point where we're almost not quite there, but we're almost flat with the at-the-money volatility, at least from a 25 delta standpoint. So, and the puts also lost some value as well on the short term. Now, I agree with the statement that was made that, yeah, puts are definitely bid to the calls, like you said, but from a relative standpoint to the at-the-money, you're seeing the calls definitely increase in value and the puts losing a little value. So that's where some of the attribution is coming from on the skew values.
Yeah, crude skew has kind of always been an interesting thing. And it's an interesting bellwether. Maybe we'll get to it a little bit later in our futures options feedback regarding some of the use cases for the skew out there and some of the things you can and perhaps can't use a skew for, but still pretty interesting stuff, we think. And we've been watching this for a while. It's kind of been when is going to have this inflection point. I think we reached that recently. And now we're seeing, of course, these near-term pushes, ebbs and flows out there as we continue to see kind of the back and forth dance between the aggressive bulls and the very, very aggressive bears out there in crude land. Some interesting things that left off the page for us. You guys can follow these along as well if you're looking at the TWIFO/TWIO report over there at CMEgroup.com. A lot of action across the board here this week. Once again, Nick, the volume was pretty heavy in one particular area. Of course, of June seemed to be lighting it up, and in particular looks like those 40 puts were really kind of leading the charge out there, with June overall kind of doing about over half of the volume again. That kind of going back to what we were saying earlier with this kind of very aggressive near-term surge in underlying futures prices. People are just piling into front month, piling into upside, getting themselves some near-term exposure to crude, however they can get it. In this case, it was June. June puts lighting it up, June 30s and 40s, but we also saw out there in July some interesting 53 calls lighting it up, doing an overall not a ton of volume, about 5,000 or so contracts, but that represents a 550% increase over last week. So that alone should tell you where those Julys were trading, how much was trading there last week. So a lot of interesting nuggets to parse. Those are a few that kind of jumped out at me. Nick, what's kind of jumping out at you from a crude perspective this week?
Yeah, I tend to agree with that. I think it's important to reiterate, like we did from the very beginning, how for people that are new to the options on futures, how a lot of the volume and a lot of the activity is going to concentrate in those early parts of the term structure. There's a lot to trade, there's a lot available, and there's a lot to pay attention to as we're looking at the market. But as you mentioned, we're up near 80% of the volume is taking place in the front part of the curve. So, when there's movement short term, that's where the activity is going to happen. But generally speaking, I think you're going to see 2, 3, 4, maybe 5 months worth of activity for these commodity options. 40 puts, a big part of that. Almost 10% of the total volume for the week, and the 30 puts are in there too. And the 30 puts had an open interest change of 7,000, which probably, the volume on those, I don't have it clickable just yet, but it will be. Volume on those is obviously above that. So you're getting, the better part, 15, 17% in the downside in that June volume today. So, or this week. So that's kind of sticking out. And also, it's interesting because we've seen sort of these put heavy months, and then we'll see a lot of call activity in months in between, and then some more put activity in the further out months. So there's definitely people are trading both ways. And again, the important thing that I want to stress, and for people that are looking or at the report or are paying attention to it after the fact on a recording, look at the put call ratios on both the volume and the open interest side. In the June, it was pretty even puts to calls from a volume standpoint. So there were people on both sides of the market, and the way this market moved this week, that makes a lot of sense, right? We don't have a lot of there was some ups and downs, but we're really not any different than we were at the beginning of the week, and that kind of holds in the July. Again, still kind of flat. Puts are still a little bit more in fashion from the put call ratio standpoint. But if we jump over to open interest side, we're going to see the first 2 months are about a 1, meaning that there's as much interest in the puts as there in the call. So still, I think even with the Alberta fire and some of the other things that have taken place out there that could potentially push the crude a little bit higher, still not seeing anybody really taking a big stand, or at least a big market stand in terms of a direction. So I know that the gas station's taking a stand, and that gasoline's going up from where I filled my tank last week. But just from looking at the number standpoint, looks like people are still kind of trying to figure out where things are. And I think the one other thing that kind of caught my eye is out in the November contract, we had the 75 strike got opened. So 3,000 traded out there, but that's a new position for about half of them. So that's a big 300% increase in open interest, but that's a big stand. And also way out in January, some 80 calls traded. So, short term, it looks like market is sort of trying to figure out where it is. And, then some flyers out there like we tend to see each week. But that's, and again, the other thing just to point out, and I think and that's for people that are new to the futures options, the open interest just keeps getting higher in these. So there's plenty of trade. and there's plenty going on. There's plenty of new positions coming in the market. But the one thing I will say again, which I just don't understand, and we've talked about this before, and I've asked some of my friends over there about it, I don't know why the weekly contracts are not trading in this product, because the short-dated contracts, in this case the June, it's 10 days to expiration, 11 days to expiration. There is a 1-week contract, a 20-day contract. I don't know why the weeklies aren't trading, and I think when people start to see that those are available, we're going to see that activity increase just based on the fact that the front month is trading so much and it's tied to the same contract. So we'll see what happens from there.
Yeah, you'd think this would be an ideal week for the weeklies, pun intended. This is an ideal use case for them. You have a very near-term gap up. This is the kind of time when you want a very gamma-heavy type product like that, and that's what the weeklies are all about. They're all about gamma. That's and decay, the flip side of that. But if you want exposure to that, you think, and everyone's piling into the near portion of the curve anyway. You're right, because weeklies have been a success story in most other futures options products. If you listen to one of our other futures options product shows here on the network, Long and Short of Futures Options, that we do with our friends over there at the CME, you'll hear, the narrative has been growth in weeklies, growth in short duration, pretty much across the board. So it is a bit of a head scratcher why in this one product that has received so much interest over the past year or so, and an explosion of retail interest in particular, who would consider to be a very strong use case for the weeklies, why they're not flocking in. That's an interesting thing. Maybe worthy of some additional consideration, additional study here on the TWIFO program going forward, Nick. Would you concur?
No, for sure. And in fact, I was looking at the markets on CME Direct early in the week, and last week and early in the week, just to see if the people were quoting them. And the people are quoting them, and they look a little wider, which means there might not be as much participation in that part of the term. But at the same time, like we said, and you hit the nail on the head, you want short-dated options when you're looking for gamma. And sure, you're going to have some decay in that, but at the same time, if you're getting movement, you're going to pick up deltas mighty quick one way or another if you're long that stuff. And it's going to be it's almost like trading a smaller version of a future, right? And if you have an opinion from hey, we're done here, we're dead in the water, it's a way to get some premium from a decay standpoint. So it seems like there's some opportunity out there. Maybe somebody out there who's listening, if we have anybody that's particularly astute at that market, gives us a heads up and give us their opinion as well next time we're on the show.
Yeah, I'll have to dig into that a little bit more because, like I said, I know the narrative has long been weeklies are a huge success story, not just on the equity option side, but also on the futures option side. You'd think the most compelling, most active, most interest-generating product on the futures and futures option side, crude these days, goes back and forth with gold and a few others, but definitely crude is up there, would be generating the lion's share of that interest. And yet, for whatever reason, it is not. Well, we've already spent a decent amount of time in crude, so we'll hop on to a few other products here, Nick, on the old TWIFO show this week. In particular, like I mentioned, one of the other ones that vies with crude for the most attention every week, even though it has been a little quieter of late, not perhaps quite as rocking and rolling, as turbulent, as volatile as it has been in recent months. That's, of course, the shiny stuff, good old gold. And again, we're seeing a lot of interest in one particular area. In particular, it was June yet again. So a little bit indicative of what we saw, something along the lines of crude, where a lot of the paper just flocking into front month and near-term stuff and not really messing about with the farther end of the curve. In this week, Nick, we saw about almost exactly half of the paper going up just in the June month, with open interest up out there about 6%. Overall open interest up about 5%. So again, open interest growing across the board, which is always a good sign in a lot of these products. Leading the charge out there in the most active month, June, were the 12.5 puts, Nick, with nearly 8,000 going up on that strike. So that was definitely the strike du jour. The next closest were the 1,500 calls, the ever optimistic 1,500s out there in July, with about 4,000 of those bad boys. I guess 1,500 was kind of the strike across the board, Nick, because it was also the most active out there in Aug and even into September, with subsequent lower amounts, about 2,400 and about 800 respectively on each of those. Also interesting out there from a volatility perspective. We talk a lot about Skew on this network, Nick, and particularly in not just things like the S&P and AKA the volatility skew of the S&P, but also in things like crude and indeed gold. And there has been a little bit of development out here as well. But we know, looking here at the TWIFO report, you're going to see that skew is coming in. That could indicate the puts losing a little bit of love or the calls gaining a little bit of love. Luckily, Nick, you have more insight into that via your high-end quick skew tools. Anything you want to share regarding gold skew out there with our listeners, as well as maybe any other activity out there in the shiny stuff this week that caught your eye?
Yeah, I'll talk to the skew first. I'm just looking at the June, and on the week, I think we got a little bit of a bid in the calls and a little bit of not much happening in the puts. So probably what we'd say is that the skew increase, meaning less negative in this case, was probably coming from the fact that the calls got, less positive. What we got here? Let me double check that one more second. We're less positive. I'm down. I'm looking here. Yeah, you know what? I'm not seeing anything too interesting there, to be honest with you. The one thing about gold, which I will say that is interesting, and once we decide how we're going to get this report out there, is you'll see that you'll see the skew flip-flop as the market becomes bullish and bearish. So that's what we'll tend to look for here, is if there's a change, we'll start to see a move towards where the calls and the puts start moving towards each other. But I'm not seeing anything in particular here. I got about a half a vol on this, with the calls being a little less bid than the puts than they were last week, but nothing too spectacular. And you see, since there's all red there, vol is generally down across the board, and again, that's going to be from the fact that we didn't have much change in where the futures are. So, or if we did have a change, we came back to steady. And that's going to generally bring volatility down. So the other thing I wanted to point out here in the gold is I was fishing around earlier in the week. I think this stuff took place was some 1850 calls traded way out about in January. Not a tremendous amount, but that strike did print, and lots of 1400 calls trading outside of the September, Nov, and December contracts. So you guys can see it for yourself now. Hopefully, we have people following along. And play with the display settings too, so you can see other things that you can find to mine here on this version of the report for gold. One other thing, Mark, just to kind of carry through the theme, the default setting is to show the weeklies when you bring this report up. You can turn the weeklies off when you play with the data display settings. But again, here's another product. Now, like you said, the weeklies are pretty hot. They're very hot in the treasuries. They're very hot in the indexes. But here's 3 contracts that are available to trade on the June underlying or June or July underlying, and not seeing much love in the weeklies here. They're weeklies spelled with an A and not an E, because they're very weak in terms of open interest and general interest. So we'll see what happens with that. I think it's going to change.
You're getting punny here on the show here, but that's an interesting one as well, because gold options are one of the few out there that really have a direct analog on the securities and indeed the equity option side of the fence, which is, of course, GLD, the ETF options in this case. You can, of course, put it in a securities account. It's a very active product because, of course, it holds the physical, so it eliminates a lot of the problems that typically exist with, your usual products that try to replicate a future and have all the issues dealing with the curve and everything else along those lines. And out there in GLD land, Nick, I'm looking at it right now as we're talking, the weeklies are extremely active. They're one of the more active areas of volatility. I mean, I'm looking right now, it's easily up there or close to the front month in terms of what's lighting it up, and certainly beyond some of the later months out there. So it is a bit of a mystery why the weeklies in a GLD, something like that, would attract a lot of interest and attention, and yet they're very much surrogate counterpart out there in the big futures options would be attracting less of interest. Again, that's maybe a little bit of a mystery. Maybe we need to set to ourselves here. We'll be the detectives on future episodes of TWIFO. Are you up for it there, Mr. Nick?
Yeah, no, I think like I said before, I think I'm going to spend a little bit more time looking at the spread on the markets and seeing what the depth is on them if I can find it, because there's really, in my opinion, there's no reason for it, especially with short-term movement. It just seems like a natural fit for people that want to trade. If you're looking to trade the market and you don't want to trade the underlying, this is a perfect way to trade it. I mean, it's the short-term options are going to have big gammas, which is going to make the deltas, move very quickly, which is going to allow you to get in and out of those from a price standpoint, if there is movement. So we'll see. I'm definitely up for it, and I think we should. And I guess we could ask the question of too is why the treasuries are so active. It makes sense why the S&Ps are, but the treasuries are very active, and what can they do over there to make these other commodities, have that same kind of volume, because they get big volume in the treasuries. So it doesn't make a lot of sense.
Well, we're coming up against it here. You can probably debate that for quite some time here, Nick, but I want to make sure we squeeze in a couple other products here before we sign off, because we like to give people the full array, the full snapshot of what was lighting it up out there in futures options this week. Like to mix it up with some interesting new products. We've been talking a bit about beans of late, Nick, and that's one of the areas outside of the crudes and others that has been exhibiting a little bit of life, a little bit of underlying movement, a little bit of volatility changes, and a little bit of volume out there to match that. And this past week, no exception. Open interest growing nearly 9% from an options volume perspective. So clearly a very aggressive. Also, the nexus of liquidity a little bit farther off out here. So kind of a little bit different paper than we're seeing out in, let's say, a gold or a WTI, Nick, where it's primarily near term. The strike du jour from a volume perspective this week, the month du jour was November out there, and in particular was the 1,100 calls out there in November that were really lighting it up. We also saw back in July the 1,000 puts lighting it up, 1,000 kind of a strike du jour in June as well, both on the put side, again, being the out-of-the-money strike out there with about nearly 12,000 and about 15,000 respectively of each of those. So those being the three kind of strikes leading the charge out there. The biggest open interest gains also out there in July with about 10% increase out there. So interesting volume gains in Nov, but open interest changes the greatest out there in July. Some interesting stuff. We've been talking about beans a lot, and particularly towards the end of the week here, had a bit of an interesting move. What caught your eye out here in the beans, Mr. Nick?
Yeah, I know. I was looking at this yesterday, and I thought we were going to have a kind of a fun story based on the fact that the front month traded all the way back down to $10 a bushel, and it was going to tell a good story about how the skew came in because we were backing off of the highs and that kind of thing. Now you'll see the numbers on here, and the skew did come in, meaning the calls are less bid than they were, and the puts are more bid. So you see those things converging on each other. So there was a lessening in the call, bid of the call, and an increase in the bid of the put, moving more towards the volatility level of the at-the-money. But all over the course of today, we had a rally. Erased all the gains for the week, and then we're up. So I think it's going to be an interesting opening to next week. So I'm going to pay attention Sunday night to see what happens, and that should give us a little bit of an and the other thing too is I think that the volume on this rally was pretty distributed across the price array from the $10 low to where it is right now. So I don't think it was any big gap or anything that occurred. It was just a general sentiment increase again. So I want to find out. I'm interested to find out where that heads next week. Now, as far as the volume distribution here, I'm learning, again, as everybody knows or has heard, I'm an interest rate guy, so I'm learning more and more about the markets, even though I understand the pricing and can look at it, but just the mechanics of the markets and those type of thing. We're going to see prior to the November contract is like the new crop contract, and the contracts before that are the old crop. So that's why we probably see a little bit more even distribution here in the curve, because when they trade November, they're talking about the things that are getting harvested this summer. So that's a new crop, and these other prices for the June and the July and until November are for the old crop. So the stuff that's already harvested, that's in silos or in storage and stuff like that. So that's probably where we're seeing the distribution of the volume. So it's almost like two different marketplaces. So that's what I think the most interesting thing I could point out here today as far as the beans are going, other than pay attention because the skew is starting to come off, meaning we're approaching each other again, and I'll be interested to see how the market treated it today, because this is a skew from the shape of the curve from last night's settle. So I'll be interested to see how the shape of the curve has changed once we get to settlements tonight.
Yeah, interesting stuff here. And as we're coming up against it here towards the end of the show, and don't worry, we'll be getting some questions from you guys. We'll get to them all on future shows as well. Maybe when Nick and I are gallivanting in Los Angeles next week for the big options industry conference. But before we go, I'd like to mix in some new products as well every now and then here, Nick, when ones we haven't discussed previously on the show, or at least not in some time. This time, going back to the energy space, in particular Nat Gas, taking a nice look at what's been cooking out there in Nat Gas. If you've been watching this product of late, it's interesting. It's always interesting too, Nick. The strikes of these things are always, depending on the different products, are always so different. We were talking 1,200 earlier and things like gold. Now we're talking, 1.75 out here in a product like Nat Gas. So it can certainly become confusing to a lot of our listeners on the outside who are just kind of novices to the world of futures options. But don't worry, we'll walk you through all this fun stuff. Out here in June seemed to be where the greatest aggregation of the volume for this past week was out in Nat Gas. About nearly half of all the volume going up out there. Again, front portion of the curve. Similar trade seems like across the energy play right now is all in the near portion of the curve as opposed to what we saw just now in the beans. The 1.75 puts leading the charge out there in June with about 13,000 contracts lighting it up. That was the biggest trade out there, biggest strike out there by far. The next biggest 2.5 calls out there in July. Who knows, Nick, maybe a little bit of a risk reversal going on out there. About 10,000 or so of those guys trading this week. Open interest also strong out there, growing again out there in Nat Gas this week with about 3% increase over this time last week. So some interesting stuff. Let's bring it home, Nick, with a new foray for the show here. Let's talk a little bit about what caught your eye, if anything, out there in Nat Gas over the past week.
I think the most important thing to point out here, especially since it's the first time we're really talking about it, and this is, again, the listeners, I'm learning as we go along with the reports as well, because my objective here is not only be able to talk about the rates, but be able to talk about all of the futures markets, working with the different people that are experts in these areas and trying to pass that information on to you. So first off, keep in mind that, we look at this from everybody kind of looks at things in a calendar year standpoint, but really the nat gas market, they think of it as summer and winter. So you break up the expirations in the following way. So June, July, August, September, and October, that's considered the summer months. So that's why you're going to probably see most of the activity in the front month, because that's in this case it's June, but that will change as the expirations roll off. So June is going to be the contract that people are going to trade to start getting into the summer pricing for the nat gas. And then for the winter, it's, November, December of this year, and then Jan, Feb, March of the following year or next year. So that's, if we go look at our report, then we're going to see that. We had a big volume base in the June contract, and then when we come back down, we're going to start to see. We'll see it decrease as we go along. But let's start, as we talk more about these products, we'll start to think of it in summer and winter. And as we learn more about the distribution of the trade and that type of thing, we'll be able to focus on the different expirations and really get a good feel for, what people are thinking. So not much in terms of winter month activity, obviously, because we're in the summer. So the most important part of the summer being what's in front of us, which would be June contract. So I don't really know that there's too much to point out here other than what you've already talked about. But I think if we can give our listeners a little bit of a nugget or a tidbit or some new information about a market each week, then I think we're doing our job as well. And again, I'll say the same thing like I said before. The weeklies are weak here, and I think we're going to see that change as people get to know about them.
All right, sir. That music means we're coming up against it. They're getting the hook. We're getting the hook here on the old network. Well, we love doing this show. We can probably, obviously, Nick and I could go on for some time talking about all things futures, options, what we have to leave you for this week, listeners. But a good point there, Nick, as well, about the kind of nuances of each of these different products. It's not like people are used to the Apples, the Facebooks, the SPYs, which have relatively similar volatility skews, relatively similar trading styles. It varies product by product out here, which is what makes the futures options landscape so unique and indeed so compelling to a lot of options traders, because every new product is indeed interesting and a new puzzle to be solved. So that intrigues you. You're looking for interesting opportunities, and indeed, as we pointed out here on the show, yet again, more volume, more volatility. Futures options are the place to go. We're going to break it down for you every week right here on This Week in Futures Options. Nick, you and I are going to be traveling next week, so I'm looking forward to that, the big options industry conference. But before we go, what's cooking in the land of quick strike that may interest our listeners until the next time we can all gather together here?
I think the biggest thing that I could say is if you're a Quick Strike user or you're considering using Quick Strike and you start to get out there on the app, we're restructuring some of our user experience and user interface. So it really lets you dive very deeply into a particular expiration or product. And while you're on a page, start looking at things without losing your place and really taking a look at history, taking a look at details of an expiration in a really comprehensive fashion. So that's the big cooking there. Other than we'll be adding new products over the summer, a lot of new energy products. So, stay tuned and I'll make you aware of what's happening on that front.
All right, thank you for that, Mr. Nick. Thanks to all of you for tuning in to This Week in Futures Options, and we'll see you next week for more breakdowns from the world of futures options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.